Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Ravi Shankar, Managing Director, Head of India TMT Investment Banking at JPMorgan India. Joins us right now on the show. Ravi, great having you. I hope all is safe.
Likewise to you. Good to have me here, Neeraj.
No, pleasure is ours, Ravi. You're a man who wears many hats. Let me try and look at one particular aspect of the multiple things you do and focus a bit on that. We thought it would be great to understand from you, Ravi, as to how do you see the deal flow, investor appetite, as well as the kind of paper that is coming out of India in this new age world, so to say, in this whole tech and tech related space. Is it something that is mightily different from what you've seen thus far happening from the Indian shores?
Absolutely. I think what we have seen this year so far is nothing that's ever been done in India, right? Both in terms of volume as well as quality of business that are coming out. So just if you were to look at the volume of the business, is almost 1.5x of what we saw last year, full year, compared to what we have seen in 8 months this year. And I won't be surprised if it becomes 2.5x of this last year by the time we finish December or Christmas. And I think that has been really a confluence of two things. One, COVID-related acceleration, the digital adoption, which has many facets, and I'll talk about it. And the second is the liquidity flow across the world, which of course has also been a great influencer in the way people are deciding how to invest and where to invest. But the fundamentals are really strong, and that come from COVID-related acceleration, where customers are willing to pay for convenience and delivery. Customers understand, that having a contactless consumer purchase behavior is much more important to them, and all of that has impacted the economics of all the startups that we see. And what in a way worked out very well was when last April and May, India went through a severe lockdown. Almost every startup went through a serious rethink of their cost structure and what they need to do to get healthy unit economics. And that actually got their cost structure right. And then on the back of that, when customer came back and started paying for convenience delivery, their unit economics shot up. And all of that has been great from investor perspective, because they can now see a really path to a sustainable unit economics, and then that's showing up in both the funds flowing up in private and public markets.
I have a couple of things. Actually, let me look at zoom out a bit and talk about the landscape, and then I'll talk about some of the idiosyncrasies as well. How big is this whole China curbing its tech sector impact on the Indian landscape? I mean, so many people make it sound as if with India and a few other countries now being the only destinations and China doing what it is doing, if the appetite was X, it will now be 2X or 3X. Is it actually that, and is it as simple as that?
No, look, I think there are several facets to do. One, for sure, is to establish India as a country where the regulatory environment is much more stable, and investors love that. So that, I won't take away that point. But I think we are oversimplifying it when we say that, China will attract less capital, and that capital is going to come back to India. I think capital goes where the investment opportunities are. And even before what we have seen in China over the last few weeks, the capital that has flown in, for example, we raised $3.6 billion for Flipkart. And the interest that we saw had nothing to do with what's happening in China. It was really a reflection of what the macro story is there in India. And I think that's supreme factor for what we are seeing in the market right now. So I would say, yes, it is a positive in the sense that India is becoming even more differentiated with respect to the regulatory framework. But I don't think it's either or, that, people either go to China or India. Also and done, China, the money that flows into China is multiple times what flows into India on a regular basis. So I think that's just one factor, but not really the one that will drive capital to India.
No, fair point. But has it, I'm just trying to ask you in a crude way, has it become easier, so to say, relatively easier to sell an Indian paper because the quality was anyways what it was before and after, but now you also can talk about how easy or how stable the regulatory framework might be out here versus the, how do I say, the volatility out there, if you will.
Absolutely. So I think that's the point I said, and I think it's indeed. And look, I guess every sector you look at, whether e-commerce, tech, gaming, fintech, all of them have some regulatory element, and having a comfort that there will be a gradual process of regulation. I don't think any investor is against regulation. I think they just want to know that this is stable, and there won't be a one fine day a sudden regulation clamping down on activities. So I think that not being there is a great positive for India, and I think it's indeed helpful when you go and tell the story to the global investor community.
The other aspect was with Zomato getting or doing what it has done, the appetite that it drew and the listing and the post-listing performance, early days, but still, the expectations that people have around Nykaa, for example, are these first signs of exits being possible to early stage investors, beefing up that side of the business as well, wherein people are now maybe a lot more confident in doing way before in the life cycle, but a pre-IPO deal, so to say, because they know that at some point of time, the exits are now a distinct possibility in India, which was probably not the case maybe 5 years ago.
Absolutely, and I'm seeing it across product, right? So India IPO is one factor where Zomato is clearly shown and now card trade, and I think there will be many more. Paytm and others will come in where it will be clearer that you don't have to stay private to attract capital, and really public market is there to support you. But I think we are seeing it in multiple other facets. One other is US IPO. We just flipped public Freshworks, which is a SaaS company out of India, which is another significant kind of a landmark event where an Indian company will be listed in the US with a fanfare that it will. And then the third is M&A. I mean, what started with Walmart acquiring Flipkart and now PayU or Naspers acquiring BillDesk is another example of exits coming in multiple ways. So I would say, yes, Indian IPO is a landmark event in the sense that people had this perception that the capital market will not support companies which are loss-making or have unit economies which is not that well established. But that clearly that notion has gone away. But I think what investors are also getting very, very excited about is that exits are not that difficult. In fact, just if you look at even the private capital market, almost a third of all fundraisers are secondary in nature. So the exits are coming in so many different ways, and it's all positive for new money flowing into the sector.
What is the most exciting thing that you are seeing in terms of maybe the type of paper coming in, or as you said, a US listing for an Indian company, which not too many people are aware of, right? What are the most exciting aspects that you are seeing of late?
Yeah, so look, I think when if you think about 4-5 years back when we started seeing unicorns coming up, a lot of them were really analog of foreign companies or US companies, business model which were like calibrated to suit Indian market landscape, but nonetheless analogs. And that's why you saw multiple clone also coming up. So you had a Flipkart, but you had 4 or 5 other guys who were coming in horizontal e-commerce, and similarly food tech and so on and so forth. What we have seen over the last 2 years, which I think is most exciting, is really entrepreneur thinking afresh about business model that will really help the pain points of local commerce ecosystem. So if you think about edtech, is indeed something where we are revolutionary. Baiju is the largest edtech company globally. Similarly, if you think about entire SaaS segment, I feel very excited about. In fact, what we are doing there is repeating the success we had in IT services, where we are using efficient engineering talent in India to solve global IT problem. Now we are doing in product space, which is even more interesting because it's non-linear, and plus the market is huge. So Freshworks is one example, but you think about Druva, Icertis, Browser Stack, ChargeBees, MindEagle, and Postman, which just got valued at $5.6 billion. I think all of that are a great example of Indian using the talent here to solve global problems and doing in an innovative manner, which I think is finding a lot of resonance with the investors.
You see the advent of the Indian product sector the way services was for the last so many years, that products could finally make a comeback, because in the listed space, you had examples of services companies which tried their hand at being product companies and not quite getting the acceptance because of the unpredictability of revenues.
Yeah, so I think we had this situation where we had product company which was catering to Indian enterprise, Indian corporate. I think that business is still evolving. I think the scale has to build up, and unit economic has to get set up. Where we are seeing most of the activity taking place, and I think that will be really a juggernaut going forward, is really Indian companies going and solving the problems of America and European corporates, and doing it in a manner where they're really taking with a legacy product, supplementing with their product, which is really software as a service, and doing on back of low cost engineering talent, which is out there in India. So really, instead of us being just a captive center of global product companies, we are now making product company here, which is really something to be proud of.
Okay. Ravi, may I ask you, how are you yourself? I mean, and of course, give us a sense of how do you think the market would as well, and both the ways could be different. But how are you valuing some of these companies? Because you have a plethora of different kind of companies coming, right? I mean, there's a lot of promise in Zomato, even though it may not be making profits. A lot of question marks or what have you around what a Paytm might be doing versus what some of the other established fin companies who might be on the way to become fintech companies are already doing. And then we have other examples of companies which are profitable tech companies also coming into the fray. So how is it that you think you would want to value some of these names, or as a standard practice, if you will? And how do you think the market would anyways take to it, irrespective of maybe you might be at a dichotomy from what the an obtuse way from where the market might value them?
Yeah. So look, I think the public market, the way they value companies, the traditional way is to look at the earning or EBITDA that the company is going to generate next year, or the revenue, and then you put a multiple to that. I think that works very well for companies which are growing 15%, 10%, 20%. That's not the lens that we need to apply, or we should apply, to companies which are growing. If you look at India tech ecosystem, anywhere from 40% in commerce to 150% in SaaS. The way investors look at it, and which I think is the right way, is to really think about what is the period over which I expect this company to continue to grow at this explosive pace until it tapers down to something like 20%. And that could be 5% in some case, could be 7% in some case. You actually go and apply the normal public market multiple 5-year hence on that EBITDA at that point in time, and then you discount it back at the cost of capital that you have. If it's a public market, it's more like 30 to 15%. If it's a private market, it's more like 20 to 25%. And then you look at the value. Now that value will be a much higher multiple. So instead of maybe a 30x P, it will look like 120x P, because simply the cost of capital is so much lower than the growth at which the earnings are compounding over the next 5 to 7 years. But that's all right. What is important is to capture the value of that growth, and looking 5 years out and then bring it back is the way investors are looking at it.
Okay, and you concur with that methodology? You believe that's the right?
Absolutely. That's the only way you can do justice to the kind of growth these companies are going to have for a long time. And look, I think public market hasn't seen such fantastic growth for a long time. So I think it will get, it takes some getting used to, but I think we are seeing the early sign of that happening. In fact, we obviously are in the market trying to, make sure that both investor side and company side have their perspective to share. We're having our, annual India Equities Conference late September 20th to 22nd, where we'll have, a bunch of corporates, 200 plus investors coming in and talking about talking about these exact issues that you're talking about. But I'm a big votary of paying for the growth, which is supernormal growth for the next few years in the wages outline.
Okay. Last couple of questions, Ravi. One is in some of the pockets, there is an obvious duopoly or oligopoly, so to say. In some, these companies are challengers or were challengers maybe 2-3 years back, are now coming up. In some categories, they will be challengers. Do you think, again out here, that you, as somebody who looks at this space closely, would differentiate in how you would assign any kind of value to X versus Y versus Z?
So look, I think it goes back to the earlier comment I made, which is earlier we used to see a number of clones of global analogs coming up and then fighting for capital. I think we are seeing less of it. While you see a lot of capital flowing in, I can tell you in any segment, it's really the top two guys who are getting funded, not the number 3, number 4. We have seen across social media, we have seen across edtech, professional skilling, and so on and so forth. There's significant amount of consolidation taking place as well. I think leaders like Byju's or PharmEasy have been doing that. So I think capital will be discerning. It feels like it's not by the amount of funds which is flowing or number of unicorns getting generated. But I think this is quite different from what happened, let's say, in 2015. And I think that's a good, healthy sign. For sure, over time, you will see more consolidation in the sector. But even today, okay, I think the funds are really flowing to number 1, number 2 player, not anybody else.
Not trickling down. Last question. What can derail this party? And can talks of taper or the actual taper itself, some flow back out of liquidity, impact the appetite for some of this paper?
Yeah. So look, I think one question is about the valuation mark, whether they will sustain as much, and the second is whether the fund flow will dry down. My sense is the fund flow is not going to dry down because the fundamentals of the business, which is the acceleration in the entire digital adoption, consumer behavior, is here to stay. We have been in this COVID period now for almost 18 months, and I don't think it's going to go on for another 6 months. I think that is a long enough time for a consumer to change his behavior in terms of how they think about ordering things online, or using some of these fintech payment of paying. So that is out there, and fundamentally they are not going to change. What is going to change if there were to be taper is some pullback, which we have seen in 2013. I don't think it will be as dramatic simply because I think Fed is very, very careful about the wording they use. In fact, you can see the recent FOMC minutes. I think they will be very careful to actually guide the market, not only in terms of interest rate movement, but also how they'll think about reducing the amount of bond purchase that they'll do in the market. So I think it's going to be more gradual, but nonetheless, it will not impact the attractiveness of the sector. It could a valuation mark, but that is just the nature of the market. It goes up and it goes down, but the fundamentals of the sector is intact, and I think that will attract enough capital for it to keep healthy. What I would worry about is if the current buoyancy in the market changes some of the entrepreneurial behavior to go and use capital as a differentiator rather than business model as a differentiator. I think that we saw sometime in 2015 and 16 heydays. I think it's not going to happen this time simply because people have learned their lesson and the boards and the investor are going to keep people disciplined. But I think if there's one concern that I have, it's more of that than really the fund flow.
Well, hopefully they have wise men to advise them to not go down that path. But Ravi, this was a pleasure. Thank you so much for taking the time out and giving us some insights. Maybe we can talk again in 6 months' time to get a sense from you about how the preceding things or the next 6 months have shaped up. So it'll be lovely to do that. But thank you so much for speaking to us today.
Absolutely. Pleasure talking to you.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.